Just initially, one of the big topics in the market's been, the contrasting valuations between retailers and resources, and I think, Shaun, that's a good way to kick the discussion off today. Let's have a quick overview on some of the sectors that are looking a little bit overvalued or stretched, in your opinion.
Warren, we've configured our process to pay special attention to not overpaying for a stock. In terms of our process, we say we like to put risk first. And what this means is we'd like to ensure we're not going to lose money for our investors. And I think if we look at the JSE at the moment, it's clear to us that there are pockets of the market where people are taking excessive risk and stocks are overpriced. And we think there's a meaningful chance of investors not only suffering mediocre returns, possibly losing capital. And then the flip side of that equation is there are pockets of the market that are clearly unloved. Specific reference to the more value part of the market, resources, etc. And for us, if you pick carefully in the undervalued, unloved part of the market, your returns are going to be good. And if you were to invest in the much loved, overpriced part of the market, you could lose money.
I think it would be safe to say we're probably talking, when we talk about the overvalued side of the market, we're probably talking about retailers. And I think everyone's familiar with the story that a lot of foreign investors have been buying the retailers. Has the stretch in the valuation surprised you, especially with regards to retailers like ShopRite?
Look, it's certainly surprised us. We haven't been invested there for a little while. So the extraordinary returns from last year definitely surprised us. But having said that, we've been in the market long enough that we know when people like a story, the money flows there. People take the good news, they extrapolate it into the future. People seem comfortable to buy stocks on high earnings with high valuations. We've seen how this movie plays out, and we can't help you with, when it ends. We just prefer not to invest in overpriced stocks.
So for you, very little exposure in the fund at this point to all of the South African retailers, or there's still one or two that you're quite comfortable holding at this point?
We own no SA retail stocks across any of our funds, but we are lucky in the sense that we've got a totally integrated offshore local process, and we look at offshore stocks exactly the same way, the same people as we look at domestic stocks. And for interest's sake, we see tremendous opportunity in some retail names offshore, and we actually have quite significant exposure to some of these offshore retail names. The likes of a Tesco or a Walgreen spring to mind, and we see the risk return on those opportunities relative to what I can see on the SA space as being fantastic.
It's always fascinating, I think, looking at market inefficiencies and some of the reasons there, and I guess the contrasting reasons why some of those stocks you mentioned, like Walgreen and Tesco, are underpriced in your opinion. Any ideas why global investors have been neglecting those big names?
Look, there's clearly fear around what's happening offshore. People are a lot more bullish the SA consumer than they are the US, or in particular the UK consumer. And there's been an appetite around the world for areas where people see defensive growth. So, I think there's a view that South African consumer offers you defensive growth, and hence the stocks are very well bid up to the extent that we think they're overpriced. If we were to look at the comparative stocks offshore, there's still the opportunity to buy stocks single-digit PEs in some cases where people are taking an extremely gloomy view. And for us, the most exciting part is if we actually look at those companies, to us, they're high-quality companies. They're high-quality names, strong market shares, fantastic businesses. And when we model them on the types of returns that we could expect, the returns should be very good.
Bringing our attention back to the local market, and you mentioned the gloomy news, a lot of gloomy news around resources. How have you approached resources in the last 6 months with regards to the fund?
Look, resources from afar look like a clear opportunity. Valuations are as low as they tend to get. Some of these stocks are 80-90% off their highs. So as contrarian investors, it's naturally a place where we would start looking for opportunity. The issue with resources is that it's our view that one needs to be particularly careful, and we rigorously apply a metric called margin of safety if we're looking at a resource stock. What we're trying to do is ensure that a company that we invest in won't lose us money even in tough times. So on a conservative valuation, there needs to be significant upside and very limited downside, a concept of asymmetry. And we think there are those kind of opportunities within the resource sector, but we think you need to invest quite carefully. So to give you an example, one of our highest conviction positions is Anglo-American. We own a lot of Sasol, and at a point last year we invested in the platinum sector for the first time in a long while. And we're quite circumspect around platinum because it's a single commodity. These are single commodity producers. They've got big problems with their costs and big problems with labour in particular. So that margin of safety needs to be pretty large. And for us, Lonmin, in the midst of the crisis, after the rights issue was announced, you in reality had a blood on the street type situation. We concluded that the margin of safety was enough to warrant an investment in Lonmin, so we own Lonmin in our portfolio.
I'm intrigued to find out why Lonmin versus perhaps Amplats, which seems to be the biggest producer, versus an Implats, which has some great low-cost assets. Was it just a case of valuation, or were there other factors that you considered when you made that?
Basically a case of valuation. So on the basis of margin of safety, we looked at Lonmin and thought because there were balance sheet issues, and remember post the rights issue, we thought the balance sheet had been more than fortified enough. When we look at Implats or Amplats, we just don't see the margin of safety, and we would conclude that to make good returns out of those companies, the platinum price needs to move up, and we prefer not to take a view on exactly what the platinum price is going to do. The company needs to offer value without taking a view on macro events.
Just in terms of the way I think about resource companies is almost a margin between the commodity price and the costs. Obviously, costs have been a big thing in the South African environment now for a couple of years. Costs almost, you could argue, outside management's control if you look at electricity and labour to a degree. Is over the long term, platinum is only found really in Southern Africa, but over the long term, with regards to other resource companies, are we facing a point where we're almost becoming priced out of the market? We're becoming too expensive relative to peers around the world?
Well, I think what you're saying speaks to exactly why the valuations are where they are, is that there are big structural issues in the industry. I think we all know about them, and hence that's where the opportunities have arisen. At PSG Asset Management, we would just be quite careful about how we approach those opportunities. We wouldn't go in there on a blanket basis and just buy stocks because they're 90% off of their highs. We would prefer to buy companies where we think the margins are going to be okay, even in a tough environment. So we're talking typically low-cost producers. Typically, we would prefer a diversified portfolio, and typically a company that's going to produce cash even when times are tough.
You've mentioned Lonmin as a play in single commodity shares. Any others in the single commodity space that you favour at this point?
No others.
Okay. And with regards to the broad diversified miners, Anglo-American's one of your highest convictions. Are you holding any of the likes of African Rainbow Minerals or Billiton at this point? We have a position in BHP Billiton, but BHP Billiton has been getting much closer to our estimate of fair value, and we've been reducing the position in our portfolios over the last 6 months, but we do still have some BHP Billiton. Okay. Moving away from resources for a while, at the presentation today to your investors here in Rosebank, you talked about Adcorp as having a moat, an economic moat. Tell us a little bit about Adcorp and what you found interesting from that perspective.
I think we all know that the relationship between employers and labour in South Africa is a big problem at the moment. We need to look no further than Marikana and the strikes last year to highlight that. What we've got is a highly regulated labour industry where, despite government's best intentions to create permanent jobs, the structural nature of the labour market makes it extremely difficult, and it's quite clear that employers would prefer the flexibility of companies that provide contract or flexible staff. Government is also in the process of imposing some quite serious regulations as far as contract workers are concerned. And we think the consequence of these new regulations plus the existing framework of legislation plays quite nicely into the hands of the strong players in the staffing industry, because we're pretty sure that one of the consequences will be consolidation. It will be the smaller, more reckless industry participants disappearing, and very much a case of the strong getting stronger, barriers to entry being raised, and typically the consequence of higher barriers to entry and a stronger competitive positioning means you can extract more pricing power. So we would look at the strong players in the staffing industry looking 5 years down the line. We think they will extract pricing power, and we think a company like Adcorp trades on attractive valuation on low earnings. So we see an attractive margin of safety there.
Now, I was under the impression that these labour broking companies or companies that staffing companies that had a labour broking component were quite vehemently opposed by the unions. So you kind of see at this point that framework's not going to come to an end where labour organisations are going to be prevented from doing what they've been doing for the last few years.
You'll recall that just over a year ago there was a strong push, COSATU-driven push within government to have labour brokers banned outright. Government has decided not to ban labour brokers, but they've imposed heavy regulations. We have a view that regulations often have unintended consequences, and we think in this case the fact that there's strict rules around being a contractor will play into the hands of the strong players, and actually, if anything, entrench the position of the strong staffing companies.